A solid payrolls report. I thought we'd start this show by making up excuses for a weak jobs number. We got a strong one.
Right. So we actually went in looking for this weak number with the whole GM strike. I actually don't think this number told us a whole lot. We've known that the labor market is very strong. It is slowing from that 175,000 pace to the 130, 140,000 pace. I think the big question is the global growth slowdown, is the manufacturing slowdown, is that having an impact on the labor market? Not yet. So I think it actually solidifies this whole Fed pause. I'm not sure that the Fed is done, because I think at some point when businesses have cut back on capex, they're going to have to cut back on hiring. So I think it's just not yet so far.
You think the jury's still out on this economy?
I think it is. I think global growth continues to be pretty weak. The China PMI numbers are not really showing this big rebound. We haven't really had any stimulus, and I still go back to what Chair Powell said in July, that no business executive has gone to him saying that it's because of interest rates that they're not cutting capex. How are we solving this? We're cutting interest rates. So I don't know if they're actually putting enough the right stimulus in. So if the fundamentals are still weak, I think hiring is going to slow down over the next 6 months. I think this is just a slow uncertainty shock. So we're not seeing that sudden drop in payrolls that we're used to.
Bob Michael.
I think it was an okay report from the rather morose expectations. Let's remember, it's one that's heavily distorted with the GM strike. It will be revised. It's backward looking. And I think what we should do is step back and say, if it's so wonderful, which the market seems to be pricing in today, why does GDP continue to drift lower? Why are we at 1.9% GDP growth and not at 2.9%? I wouldn't put too much into a single report today.
Does all of that resonate with you, Gershon?
Yeah, I broadly agree. I think that, the number was strong, but we didn't learn anything new by that. You saw that at 10 o'clock, you saw the manufacturing number, which the good news is it ticked up a little bit, but it's still very weak, about a standard deviation below what's normal. And at some point, those are going to have to reconcile. Either we're going to get a recovery, or I think more likely we're going to end up seeing it spill over into continued business confidence, and it'll impact hiring, unemployment. And what's important, I think, is looking at the broad fixed income and equity markets are telling you two different stories. The equity markets are siding with the consumer, which makes sense on the surface. It's a much bigger part of the economy, but the fixed income markets are signaling caution.
Well, let's get to the analysis first and then get to the market call. You've touched on something really important, the sub-50 ISM. And to characterize the US economy as a tug of war between consumption, resilient, and business spending really quite weak. Do you think we need to resolve that in the coming quarter then, that at some point either the consumer cracks or business spending picks up?
I do think that's the case. I don't know if it's in the next quarter, but in the next, let's say, 6 to 9 months, we're going to see. The question really is, and you're not going to see this in the data, is this a blip or is this the start of a trend? Has the kind of, there's no certainty, but at least the trade tensions have been on the back burner for a little bit. Is that giving business more confidence? You're not really seeing that in kind of the earnings calls that companies are doing. They're still saying they're very, very uncertain. So at some point, we think it's going to have to spill over to the consumer.
The economy, though, to many people watching this program, might be quite good. They might say it and say, you know what, things look resilient, things are okay, the Fed's made the right decision, they're validated by taking a pause. Are you saying they're making a mistake, Priya?
I think given what they know right now, they've sort of exhausted this preemptiveness. I think Chair Powell does face a pretty divided committee. He had half the committee that didn't want to cut at all. I think they pushed this insurance cut, mid-cycle adjustment as much as they could. Now they really need validation on the data. So we have been calling for a pause, but I think this market pricing in only one rate cut next year, I think that's much too optimistic, because we still don't know that the global growth picture has really moved much higher. So I think if the hiring picture slows down, we actually think the Fed will be back in. And as Chair Powell said, they need a material reassessment. So it's not going to be one rate cut. It's going to be 3 rate cuts or more.
You think we could get 3 cuts in 2020?
That is our forecast, because we think over the next 6 months there will be that material reassessment, which will force them to come in at least 275. Maybe they'll have to do more, but if there's no recession, we're not forecasting a recession, but they'll at least 275.
For what it's worth, I don't think you're too lonely around this table today. I got the Bob Michael notes around about an hour ago. Listen to this. The Fed is behind the curve. They overestimate the probability of compromise on the trade front and underestimate the spillover impact from manufacturing to services and employment. You sound quite bearish, Bob Michael.
I do, and I think what's missing in all of this is going down to the grassroots level. And what we're hearing from companies is they're struggling with margin pressure. So they're feeling the impact in trade, they're feeling the impact of higher cost from their suppliers, and it's having an effect. how do companies traditionally respond? They cut costs. What does that mean? It means fewer employees, and it means less CapEx. And I think all of that is in the horizon. It's approaching very rapidly. I think the Fed is somewhat naive to assume that everything is fixed for now. So I do expect things to continue to slow down.
So I know Gershon is keen to get to the market call, so let's just get there. What is the market call in treasuries right now? Are you saying we're a buy in and around 170?
Without question, I think we've had the backup. I think there was good reason for it. I think we've had some crossover buying from tourists that were looking for some form of insurance from other asset classes they own. Now the big money's coming in. The ECB has turned on the spigot again to QE, and you're now seeing at a higher yield, and with the slowdown people are seeing globally, they're looking to the U.S. as a high yield market again.
Gershon?
I wouldn't go as far as to say duration is a buy at this point. I do think is it possible we get 3 or more cuts next year? Absolutely, it's possible. It's certainly a lot greater probability than the Fed's going to start hiking again. I don't see any real scenario that happens in the next couple of years.
When you say there's a divergence, though, in the market between equity and fixed income, what pockets of fixed income are you focused on at the moment?
Well, the overall level of yields. Right? If you believe what the equity market is telling you, you had 20% plus return in the S&P year to date, and just where multiples have gotten to, you wouldn't have yields as low as they are. That's the dichotomy. Yields should be a lot higher if you believe the economy is going to be fine. I think, look, the real thing, and we've talked about this in the past, John, is we're 11 years into an expansion. It would be nice, in theory, right? It would be nice if the world worked that central banks had this magic power to kind of keep us steady. The reality is there are shocks in the system. It wouldn't necessarily be the worst thing in the world. I know investors don't want to hear this, but it wouldn't be the worst thing in the world if we had a mild slowdown. Again, we're not using the R word, but we could have below trend growth for quite some time.
You've made that point before.
The markets are telling me exactly the same thing. There's a tremendous pile of cash that's been printed over the last decade, sloshing around on the 17 trillion size central bank balance sheet. It's looking for a home. It's taking bond yields right down in government bonds because there's no inflation. And although things are slowing down, until you see a recession and until you see a projection of much lower corporate earnings, money will continue to go into equities and continue to go into credit. And it's sort of this Goldilocks environment that the central banks have created for now, but it certainly doesn't look like the future to us.
Priya?
I think there's another dichotomy that I'll highlight, which is every time the Fed historically has eased, the curve has steepened, inflation expectations have gone up, risk assets have gone up. This time we got the risk asset move. We did not get the curve move, the curve flattened. All these 3 rate cuts, the curve has flattened and inflation expectations have declined. So the market, the rates market agrees with Bob here, that the Fed is making a mistake. I think the equity market is still saying that everything is fine for now, so therefore reach for yield. That might be the way you actually reconcile these two markets.
The real scary thing, though, is the question is, if we do get weakness, is further easing going to matter? Like, the Fed can pat themselves on the back all they want. The reality, I think you said it earlier, the problem in the economy wasn't that the price of credit was too high, right?
Yeah.
So the Fed, maybe it did impact sentiment, made business a little bit more confident, but it's not like a 75 basis points makes a whole lot of difference to the real economy. And if we get weaker, is it really going to make a difference if we cut closer to zero?
Just to wrap up this conversation, just quickly, Bob, please weigh in.
It does, because we've already seen that mortgage refis are at a very high level. So high, in fact, that the Treasury has reached its cap on what it can reinvest in the mortgage market. So these drops lower in yield do create some discretionary income across the board. Consumer level right now, corporate America down the road.
I agree. It's keeping the consumer going right now. But what happens, how much more is there to go? What happens if we start to see weakness? Is further rate cuts going to, you're not going to get that same response as you have.
So why not, you don't have inflation, why not go to zero? Just get to zero. You don't have to worry about inflation. See what happens. You can always take it back.